China's top banks face mounting pressure as their margins shrink, signaling deeper economic challenges. A sign of Agricultural Bank of China's operations in Beijing, March 2021, highlights the broader trends affecting the sector. As the world's second-largest economy grapples with deflation and global uncertainty, major state-owned banks warn that net interest margins will face increased strain for the remainder of the year. This situation reflects a complex interplay of factors, including prolonged central bank interest rate cuts, weak loan demand, and the lingering effects of U.S. tariffs on domestic markets. The sector's profit margins have been under stress since the pandemic, with successive interest rate reductions aimed at supporting a slowing economy. However, these measures have not fully alleviated pressures, as loan demand remains tepid. All of the country's top 5 banks, among the world's largest lenders, reported lower first-half margins in earnings reports, with net interest margins serving as a critical indicator of profitability. Bank of China President Zhang Hui emphasized that while the bank and its peers face common challenges, they are confident in their ability to adapt and maintain stable performance. In a low-interest rate environment, this is a shared challenge across the industry. Meanwhile, Bank of Communications margins remain under pressure, though the rate of decline is expected to slow compared to previous years. Industrial and Commercial Bank of China, ICBC, China Construction Bank, and Bank of Communications reported declines in net interest margins over the past 6 months, with ICBC recording a 2.7% increase and Bank of Communications posting a 1.61% rise, surpassing analyst forecasts. Conversely, the remaining 3 banks saw net profits fall between 0.85% and 1.4%, with China Construction Bank's decline contradicting analysts' expectations of an uptick. Non-performing loans remained relatively flat in the last 6 months, despite concerns over deteriorating asset quality, particularly for smaller businesses and consumers. Exporters faced sharply higher U.S. tariffs, further complicating the situation. To stabilize the banking sector, 4 of China's largest state lenders unveiled a $72 billion recapitalization plan in March, aiming to bolster credit flow to critical industries. Local banks also face mounting pressure to offer cheaper loans or more flexible repayment terms to struggling businesses, which could compress profit margins further. Outstanding yuan loans rose 6.9% in July, marking a record low. The property sector, once a growth driver, continues to pose a major challenge, with the risk of a real estate sector unwind looming large. Wu Jian, Vice President of Bank of China, warned that the real estate sector remains a top source of non-performing loans, as new home prices and sales continue their long-term slump. Analysts remain uncertain about when economic conditions will stabilize, with the property market trapped in a severe downturn for over 4 years. Agbank President Ji Heng stressed the importance of credit risk management in the real estate sector. A dollar equals 7.1529 Chinese yuan. This situation raises questions about the balance between regulatory intervention and market flexibility. While banks argue that recapitalization plans are necessary, critics question whether such measures alone can address systemic issues. As the debate continues, the role of policymakers in navigating these challenges remains a focal point for discussion.